Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial mumbo jumbo so you don't have to. Today we are diving into the Accordant ODCE Index Fund, the very latest SEC filing, which is basically a look under the hood of how this fund operates. So what is this fund all about? Well, it aims to track a specific real estate index called the NFI ODCE Index. Think of it as trying to mirror the performance of a basket of real estate investment funds. The fund is managed by Accordant Investments LLC, who are the investment advisor, and IDR Investment Management, LLC, who handle the sub-advisory duties. They are essentially picking and choosing other real estate funds to invest in to get as close as possible to that NFI ODCE index performance without actually owning the properties directly. Now this filing also talks about different share classes: Class A shares, Class I shares, and Class Y shares. Each might have slightly different fees or minimum investment requirements. Class A shares, for instance, have a sales load that can be up to 5.75%. That means for every $1,000 you invest, part of it goes to the sales charge. Class I shares, on the other hand, don't have that sales load, but investors might pay brokerage commissions to their financial advisors. And then we have Class Y shares with a hefty minimum investment of $50 million, so clearly aimed at very large institutional investors. The fund calculates its net asset value, or NAV daily. This is basically the total value of everything the fund owns minus its liabilities, all divided by the number of shares out there. For assets where there isn't a clear public price, like some of these underlying funds, they have to use fair value, which brings in a bit of estimation. Let's talk about the money though, because that is what everyone cares about. If you look at the expense tables, you will see the total annual fund operating expenses. For Class I shares, this is around 5.10%. For Class A shares, it's a bit higher at 5.35%. But here is where it gets interesting. The advisor has waived certain fees and reimbursed some expenses, which brings those net annual fund operating expenses down significantly. For Class I shares, it drops to 1.15%, and for Class A shares to 1.40%. This fee waiver is a big deal because it makes the fund much more affordable for investors, especially in the short term. The example for Class I shares shows that on a $1,000 investment, you might pay around $12 in expenses in the first year. Scroll Class A example, P-scaled for Class A shares, that number jumps to $71 in the first year, largely because of that sales load. Over 10 years, that cost difference really adds up. Looking at the financial highlights for Class I shares for the year ended June 2025 net asset value, per S-share was $9.21. Total return for that year was 2.43%. Now remember that total return would have been lower without those management fee waivers, which shows how those waivers are directly impacting investor returns. The ratio of expenses without waivers for Class I shares was a whopping 5.07%. That is a high barrier for any fund to overcome. But with the waivers, it comes down to 1.11%, which is much more competitive. This highlights the immediate impact of the support the advisor is providing. The filing details a lot of risks. One key point is the limited liquidity. Since this is an interval fund, you do not buy or sell shares every day. Liquidity is only provided through quarterly repurchase offers, and there is no guarantee you can sell all you want. This means your investment is pretty much locked up for a while. They also mentioned that the loss of key employees at the advisor could really hurt the fund. The success relies heavily on the skills of a few people. Another interesting risk is that the fund relies on models and data supplied by third parties. If that information is incorrect or misleading, it could mess up the fund's ability to track the index and achieve its goals. A big section is dedicated to tax risks, especially since the fund has elected to be taxed as a real estate investment trust, or REIT, if they fail to meet the complex rules for REIT status. They could face significant corporate taxes, which would hit investor returns hard. Failing to qualify as a REIT means they would be taxed like a regular corporation and lose out on the tax benefits that make REIT-S attractive. This is a major risk to consider. Also, REIT-S have to distribute most of their income to shareholders to maintain that status. If they don't have enough cash for these distributions, they could face penalties or lose their REIT status. So what is my take on all of this? Well, the fund has a clear strategy aiming to track a real estate index, but it operates in a space with a lot of inherent risks. The fee waivers are a clear positive right now, making the fund more accessible. However, the reliance on third-party models and the complex REIT status are significant points of caution. If those models falter or the REIT rules are not met perfectly, it could spell trouble for investors. The limited liquidity is also a major factor for anyone considering an investment here. You must be prepared to keep your money in for the long haul. Alright, that is our deep dive into the Accordant ODCE Index Fund filing. What are your thoughts on these numbers and what they mean for the future of this fund? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate financial insights. And for deeper discussions and to connect with like-minded investors, join our Discord community. The link is in the description. Thanks for tuning in.